Good evening, everyone. Welcome to our University of Virginia Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. Really excited to bring this content to you. This is a class that we get a chance to teach almost once a quarter for our UVA partners, and really excited to be able to bring this to you. Sorry we're getting started a few minutes late, but we just want to allow all of our guests attending tonight's call to be able to get into the class. So let me talk to you a little bit about what to expect in tonight's class. So what we're going to do is we're going to kind of talk about like the fundamentals of home buying. So the goal is to be able to have you take away one or maybe two concepts to be able to help you on that path towards home ownership. So whether you're looking to buy this year as a 23 goal, maybe next year into 24, or maybe beyond 2 or 3 years, we want to make sure you have all the tools and resources you need on that path towards home ownership. Now, tonight's class is very interactive, so we encourage questions as we roll through tonight's content. You can use the chat in Zoom, and then myself, as well as my partner, Ken, will be answering questions on air. And then what we'll do at the end of tonight's class, what we'll do is we'll go ahead and just carve out some time for some Q&A. Now, just a little quick about me. My name is Jason Maida. I'm the branch manager with American Pacific Mortgage. And what I do is I actually teach classes across the country in home ownership. So on the East Coast, across the Midwest, into the West Coast, we teach these classes, again, to help support our future home buyers in home ownership. So we specialize in first-time buyer programs. So a lot of what you're going to learn tonight are going to be first-time buyer concepts. So we'll take a look at some of the assistance programs offered through Virginia Housing. So if you're someone looking in the market of Virginia, there's some support there for you as first-time home buyers. But whether you're in Virginia or any other state across the country, there are different assistance programs that can help serve you in home ownership. So let's jump in and talk about tonight's talking points. So we're going to spend some time looking at the housing market in just a bit. There's a lot going on there. We also want to spend some time looking at interest rates and how those are, how interest rate levels, as many of you know, they're at relatively high levels right now. How is that impacting buying power? Then we're going to kind of look at a budget. Now, what does it look like to budget for home ownership? So we're going to look at a rent versus buying analysis and see, what it might take for me to become a future home buyer, and what are some things that I'm going to kind of take into account when it comes to building my budget. We'll spend some time looking at credit. How do we optimize credit to make sure we're in the best possible position to be able to purchase our home? We'll spend some time just briefly looking at student loans and how those can potentially impact qualifying. We'll talk about loan programs. We'll look at 5 programs from conventional loans through FHA loans to VA loans. You're going to learn all about different programs that are available to you as a buyer. And then we'll kind of look at some documentation that you'll need for starting the home buying process. We'll talk about those first-time buyer programs with Virginia Housing. And then we'll wrap up tonight's discussion looking at the process of buying home. So if I'm interested about some of the stuff that Jason's talking about tonight, now, how do I get on that path towards home ownership? So we're going to walk you through what we call the 6 steps of home buying to go from a consultation with us to actually getting the keys to your home. What's that workflow going to look like? And I want to spend some time talking with you briefly about what a consultation would be in designing a home buying plan for you. Okay. As a reminder, again, this class is very interactive. So we encourage questions as we're rolling through tonight's content. I'll try to answer all the questions I can on air. If we don't get to a question for whatever reason, we'll definitely connect with you offline, but we want to be able to respect everyone's time on tonight's class. Now, the class is set for about an hour. Sometimes we go a little bit over the hour mark, but we'll do our best to fit everything in that 60-minute span of time. So let's dive in. Let's talk a little bit about home buying, because believe it or not, this is probably going to be one of the biggest purchases you make in your upcoming financial future. So there's a lot to think about. And for those of you joining tonight's class, I mean, we had a busy, probably 3-day weekend. Now you're spending your Tuesday night learning about home ownership. So I'm sure there's a bunch of other fun things you'd rather be doing on Tuesday night. But, hats off to everyone attending tonight's class, because clearly you're valuing the effort and education that you're going to need and the resources you're going to need towards home ownership. So I know it's something that's a big deal for everyone, and it's going to be probably one of the biggest purchases we make in our upcoming financial future. So when we think about home ownership, there's a lot of great benefits that come with owning a home. Now, We all know rent rates are pretty high right now, right? And even though interest rates might be a little bit higher in home ownership, home ownership can still make a lot of sense because there's the ability to be able to create stability in your housing budget. There's potential wealth that's created through the growth of equity in your home. So when you think about your balance that you own your home versus what the value is of the home, that difference is called home equity. This is an asset. So you have the ability to be able to pass along this asset to heirs of your estate. And believe it or not, there's still some tax benefits that come along with owning a home. So, there's some cool things that come along with home ownership to be able to have that asset and be able to pass that along to the heirs of your estate. So clearly, this is a big deal when we think about home ownership. So when we jump into our classes, we really like to start off the class by first talking about the home budget and what would that look like for us if we were to purchase a home. So I'm going to just go ahead and switch screens here for a second. I'm going to take us through our home buying budgeting tool, and that's brought to us by Freddie Mac. So I'm just going to screen share with you guys this budgeting tool. By the way, in case I forget to mention, all of tonight's content, so all the presentation material is going to be sent out to you tomorrow morning, and we are recording tonight's class. So if you want to share some of this content with friend, family, maybe even a coworker, you can pass along this presentation material to them. So let's kind of take a look at this tool, and we're going to do just a what if scenario for us in tonight's class. So let's assume I have rent at about $1,800 a month. I have renter's insurance at $15 a month. And then we're going to assume our rent's going to go up about 5% on an annualized basis. So as I renew my lease, then my rent's going to go up 5% each year. Now, we also want to make assumptions around our home purchase. So let's say we buy a house at $400,000. We're going to put the minimum down, which is 3%. We have our property taxes, which generally, when we're building home buying scenarios for our clients, we're going to put the tax rate at about 1.25% of the sales price. Now, it does depend on where you're going to purchase in the country because different tax rates will look different based upon the area that you do want to purchase in. So maybe taxes in Texas might look different than California or Virginia. So, when we do our analysis, and we do a deeper dive, I should say, of our analysis, we'll kind of show you what that tax rate could look like. We'll assume homeowners insurance, the maintenance costs of our home, and then we want to make an assumption around the loan information. So when we think about the type of loan, the type of loan that we're looking at, we're generally going to be looking at a 30-year fixed mortgage. We have our interest rate at 7%, which you can see here on the screen. And then we have our origination charges. So when we think about origination charges will be the cost that you pay a lender for their services. Now, one of the great things about our partnership with UVA is that you actually get a discount in our closing costs. We bring down our closing costs $750, which basically takes a $910 processing fee and reduces that down to only $160. Now, discount points are something that's talked about a little bit in this market because interest rates are at higher than your average historical levels. And what discount points allow a buyer to do is to be able to bring down their interest rate by paying additional costs. So what is a point? Well, a point is 1% of your loan amount. So if I'm going to finance, let's just say $400,000, a point is 1% or $4,000. That point will equate to 0.25% reduction in interest rate. So if I pay $4,000 and I really want to get my rate down to 6.75, then that 4,000 could bring down the rate to that 0.25% reduction or 6.75. Now, in this market right now, it's really hard to get a good return on investment in discount points because it generally will take you 3 to 4 years to get a break-even hit on investments of discount points. So we'll talk about more about that in interest rates in just a second. But right now in today's market, hopefully we'll see a cycle down of interest rates in maybe the next 2 to 3 years that will give home buyers the ability to be able to potentially refinance their home. So other settlement services are going to include like title, escrow fees. They could include maybe attorney's fees. So if you're buying an estate that's an attorney estate, there will have costs for those. Those are called closing costs. And generally, we recommend that closing costs that you budget about 2 to 3% of your purchase price. And then the last section is other assumptions. So let me just kind of scroll up so you guys can see this a little bit better. So other assumptions, we're going to assume our home goes up, let's say 4% in appreciation on an annualized basis. We're going to be in the home for 7 years. The cost of selling my home, so if I'm going to maybe forecast out 7 years from now, I'm assuming my home is going to go up 4% annualized. But when I sell my home, the average cost is 10% of my purchase price. Now, that includes the cost of the realtors that are involved in your transaction, the realtor that represents you as a seller. But as a buyer in most states, the realtor is paid for by the seller. But when you turn around and sell your home in the future, you'll be paying that expense to both the buyer's agent as well as the listing agent or seller's agent for you. And then we have state and federal taxes as well as a savings rate. Now, we adjusted the savings rate up to about 3%. Obviously, in today's market, no longer is it 1%. It's anywhere between 3. I've seen upwards of 5% in savings rate. So what this calculation comes back is says, well, we know we're paying about $1,800 a month in rent. If we were to purchase, we're going to go up to $3,500 a month. Now, that being said, our opportunity over 7 years is still to save ourselves about $32,000 over that 7-year span of time by buying versus renting. Now, everybody's situation is going to look a little bit different. So, that's why it's important for us to put this analysis together for you. But ultimately, this is kind of a tool to help you gauge homeownership, because when we think about homeownership, it's not necessarily an apples to apples comparison, because we have to take into all the ingredients that go into home buying, my appreciation of my home, my tax opportunity. So all those things are super important when it comes to deciding on if homeownership is right for you. Okay, again, we're going to get all these tools out to you, so you'll have this in our presentation material, but I wanted to at least share that with you this evening. So let's go ahead and jump back into our slides here. So give me a second. I'll just kind of screen share our slides. So again, that was the Freddie Mac rent versus buy calculator. So now let's kind of switch it up a little bit. Let's talk about the housing market in Virginia. And really, the housing market in Virginia doesn't look that much different than other parts of the country. So whether I'm teaching a class in California or maybe another market, maybe a Midwest market, the challenge remains for most communities across the country is that we just don't have a lot of inventory out there. So even though we're still running at 7% interest rate levels, there just isn't enough inventory out there to support buyers' demand. So in that case, we're not seeing really a reduction in prices of homes. Now, I do realize this slide shows a little bit of a curvature here of a downward move on prices, but really, if you were to push this out further, we're kind of seeing a leveling of prices. In fact, some of the early projections we're getting for 2024 that we're going to see homes go up a little bit next year, maybe a potential 5% increase. And we'll probably be somewhat close to the same interest rate environment that we're in today. But overall, if we look at Virginia as a whole, we have an average of 20 days on the market. So that means a home before a house goes pending. So from the time it goes on market to when they get an offer and it gets accepted, it's about 20 days. But in a normalized market right now, we usually will have 2 to 3 months of inventory. We don't have that today. So things are kind of flying off the shelf, so to speak, because buyers see a property, there's multiple offers on the property. And really those behaviors, like I said, don't look a lot different across the country. So, the question is, as we're thinking about home ownership, is like, where's this market going to be for me when my time comes that I really want to kind of dive in? And I think, everybody's situation's a little bit different. Interest rates will play a role in someone deciding whether they want to buy, but more so the level of prices will play a bigger role. And when we think about interest rates, we're clearly at a higher level of interest rates. No longer are we back in the pandemic interest rate levels. We're at 2.5 and 2.75. And really those interest rates, which led to historical highs and refinances, are really creating the kind of the challenges we have in today's housing market, because most sellers don't want to get rid of those 2.5 and 2.75 rates because they don't really want to jump back into the market. Maybe they're buying it's a move up situation. They're buying to the next level of purchase price, but they don't want to pay a 7% rate loan, right? So those are kind of the conflicts we have in today's market. But as a first-time buyer thinking about getting in the market, we have to obviously be aware of where interest rates are at. So this blue line represents the 30-year fixed mortgage, which right now it's about 7%. We've had some positive movements over the last week. We did see rates on average jump up to 7.6 just about a week ago. So we're trying to settle back down in a little bit. but clearly interest rates have risen significantly since we were back in the lowest rate days that we saw, which is 2.5%. But I think what's important to understand when it comes to interest rates is, first of all, A, how do we get here? Why are we at this level of interest rates? But B, understanding that, the interest rate that I obtain today on my mortgage is probably not my forever rate. So even though we'll probably design a financing option for you that's on a 30-year fixed mortgage, we're probably going to be looking at refinancing, hopefully down the road at some point when we get back to more normalized levels of interest rates. Now, going back to the first point of like, how do we get here from an interest rate perspective? I think that's really important to understand. Those of you that are kind of watching economic news that's coming out, clearly the Federal Reserve is trying to battle inflation. And so we've seen the federal funds rate raised, almost every meeting over the last 2 years. So, it's clearly driving up mortgage interest rates. But now we may be at a place where the Federal Reserve has kind of overheated the economy a little bit. There is some debate on whether we'll see another increase of rates at the September meeting that we have with the Federal Reserve. So, we're going to be watching that really closely because some economic reports that have come out recently have brought down interest rates. Generally speaking, bad economic news equals good news for interest rates. So that's kind of how, we're looking at things in the market. But it's clearly a global economy. So something could happen in Europe that could impact us here domestically. So we're really watching things really closely. And inflation is a problem that every market around the globe is challenged with right now. Now, interest rates are not the same for all clients. And, you may have talked to maybe a coworker, a family member that got an interest rate at 2.5 or 2.75 back in 2020 or 21, and that's great. In today's market, clearly we're at higher levels, but I think it's important to understand what goes into an interest rate. So a few things to take into consideration. Credit eligibility. Generally, when you're at a 740 credit score or better, you're going to have the best available interest rates. And there's different interest rates by product. So whether I'm doing a conventional loan or an FHA loan, that can influence my interest rate. How much I decide to finance, what my down payment is. We talked earlier about discount points. So if you elect that option to maybe buy down your interest rate, you can certainly do that, but it does come with it costs that we want to take into consideration. So that's how interest rates are kind of formulated. Now, every lender will have different interest rates, and it's important for us as a lender to be able to help provide the best available interest rate for you based upon your eligibility, your product selection, and ultimately how much money you decide to put down towards your home purchase. And when I think about home buying and working with clients as much as we do throughout the day, there's usually two challenges that come with home buying. So it's either credit or it's going to be assets. So I don't have enough, funds that I've saved up because I'm maybe a little bit earlier in my financial life. So I just haven't really got a chance to save a lot. But when we think about credit, and we always talk about this in our home buying classes, because we want to make sure that our students that come to our classes, that we want to help them optimize their credit so they can get the best available product that they're eligible for. So let's first of all talk about the FICO score calculation and how it's factored. So this is the weighting of a FICO score calculation. So 15% of it is how long I've had credit. So the more mature my credit file is, the higher my credit score is going to be. 20% is going to be how much credit am I trying to obtain? So if I'm opening a bunch of new accounts, that's going to diminish my credit score. Or inquiries. So when we think about inquiries, there's hard inquiries, there's soft inquiries. Now, hard inquiries are going to impact your credit score. Soft inquiries only give lenders visibility to your credit score. Now, as our process goes, so if you decide to take the next steps in home ownerships with our team here at APM, we always start with a soft credit score because really we don't know when you're going to start that journey towards home ownership. You may be looking to purchase in November, or you may be looking to purchase in 2025. So we don't want to, hurt that credit score. So we always start with a soft score. And then 30% is going to be how much credit do I owe? That's also known as credit utilization. And that's only going to impact revolving accounts. So your personal lines of credit, your credit cards, overdraft protection, all of those things are revolving credit. As a rule of thumb, we want to have our credit cards in aggregate at least below 50% utilization. The optimal level is below 10% utilization. So let me kind of step back for a second. If I have $10,000 in credit limits and my balances are $5,000, now I'm at 50% utilization, right? So my goal to get to the optimal levels is to get that below $1,000 in total balances. Now, maybe I just booked a trip to Mexico and I charged up $6,000 on my credit card. So now I'm at a little higher utilization. That's okay, but we want to try to whittle that down, especially as we're working through the home buying process, because the higher my utilization is, it's going to impact my score of 30% in the weighting. So a third of my score is going to be leaning on that utilization. Now, let me give you a quick tip in how to manage utilization. Now, if you, as a homework assignment, you guys might not want to do this tonight, but maybe sometime this week, pull out one of your credit card statements, take a look at it. You have a billing cycle date and you have a due date, right? The billing cycle date is the date at which the credit issuer is going to send out the data to the agencies. So the three agencies are TransUnion, Equifax, and Experian. Well, that billing cycle date is super important because that data is going to say how I paid my account, what my balance is, and what my existing credit limit is. So if I can pay that balance down or off before that billing cycle date, then I'm going to bring that balance down so my utilization looks much more improved. Okay. So it's great to pay things on the due date, but you're not getting the benefit of all that work you're doing to try to bring down the balance unless you pay it down before the billing cycle date. And then the last component in the weighting is payment history. Now, payment history is going to be really zeroing in on the last 12 to 24 months of how I paid my bills. Now, if I've had past challenges, they're going to be rated in 30-day lates, 60-day lates, and 90-day lates. The higher my level of delinquency, the more impact I'm going to have to my credit score. Now, some accounts may report to only 2 of the agencies, and you may have an artificially higher score with the other agencies because maybe I had a 30-day late with a credit card that only reports to TransUnion, Experian. So my Equifax score is higher because that late doesn't appear there. So there's ways that we kind of look at it from a lender's perspective. Now, there is 3 different scores. Now, there's also 3 different models to scoring. Now, of course, we look at the mortgage model. There's also an auto model. And for those of you that use consumer monitoring tools like Credit Karma, they're going to use a credit card score. So we're going to look at the mortgage model. And why that's important to understand is because so often clients will call me and say, Jason, I know I'm a 760 because Credit Karma told me so, but why did you pull a 750 score? And the only reason why is because we have different models that we're looking at between the 2 scoring methods, right? So something to kind of keep in mind, but as long as we have that 740 credit score or better, we'll get the best available interest rates. We're going to talk about mortgage insurance in just a bit, and I'll kind of share with you how that can impact your credit score. Now, every loan program has a minimum credit score. The minimum for an FHA loan is 580. The minimum for a conventional loan is 620. Our VA loans, so if you're a veteran that's served and you have a certificate of eligibility, it's a minimum credit score of 620. And so each of those products have minimum credit scores. And of course, there's mortgage insurance that we're going to spend some time, like I said, talking about with different minimums based upon the amount of down payment and credit score that you have, as well as the amount financed. So let's take a look at some of the other score factors that we want to just, kind of key in on. When you look at past challenges, maybe you've had a delinquency or bankruptcy or collection accounts. Usually those are going to impact you in the most 12 to 24 months from the date of the event. Okay. So if I had a late that was 18 months ago, it's going to really impact me inside that 24 months. But as I get further away from the date of that last event, then it'll diminish the impact to my credit score. Now, there's 3 obviously agencies that we look at in the credit scoring. We always take the middle score of all 3 scores. So let's kind of look at that. If we have a 760 score as our highest score, 740 is our middle, and our lowest score is 720, we're going to take the 740 score for qualifying purposes. Now, that's if I'm just applying by myself. If I'm applying with my spouse, then we're going to take the lowest middle score between both scores. So let's say my spouse has a 700 high score, 680 middle, 660 lowest score. We're going to take the 680 score, and that will obviously impact our interest rate offering, potentially mortgage insurance, and the product offering. So it's the lowest middle score for both borrowers, and then the middle score if we're just applying individually. Okay. Last thing I want to kind of point out on this screen is around account closure. And I think a lot of clients, don't really understand the impact of account closure, because I think we're in the habit sometimes of doing balance transfers because now we got the new cool perk with a particular credit card, and that's great and everything, but you want to be careful that you don't close out the credit card for the old account, right? Because one of the things that we talked about just now in the weighting of a credit score is 15% being how long I've had credit. So if I had an account for 10 years, I found some really great benefits with a different card, and now I do a balance transfer, close out the 10-year-old car, that is probably going to impact my score because now I've taken out a very mature account and it's no longer part of the weighting. So something to just kind of keep in mind when you look at trying to maximize your credit score. Now, this matrix that I just put on screen is just showing you how long negative items will stay with you on your credit report. Okay, so just to give you a sense of what that would look like there for you. Okay. So question just came in, which I'll answer this really quick. The question was, what about if you close an account of a maturing CD? So good question, because when you think about a CD, that's a certificate of deposit. That is just around assets. It has nothing to do with credit. So you're okay. That won't impact your score. If you close out a credit card is what I'm referring to. Okay. Good question. So this is a matrix, again, just kind of showing you how long negative items will stay with you on your credit report. Okay. Let's talk about student loans. I know nobody has a student loan. No, I mean, most of our clients that we work with will probably have student loans. I do realize repayments are coming on federal student debt in October. So we totally understand that. And all along, though, we still have to factor in student loans into the qualifying calculation for the mortgage product. Now, if you're on an income-based repayment right now, and you already have your payment set up for October, that's the payment amount that we're going to use for your qualifying. But a lot of our clients graduated during the pandemic, so they haven't even made a payment on their student loans. So they have a couple different options. They can either sign up for an income-based repayment amount, or they can, by default, we'll use 1% of the total balances of the student loans as the monthly payment for a conventional loan, 0.5% of the balances for an FHA loan. And quite honestly, the income-based repayment is probably going to be a more favorable calculation. So we kind of encourage clients to try to get an income-based repayment set up, because that'll give them a better advantage when it comes to the lower amount of payment. So here's how that example looks. So if we had a $75,000 in aggregate balances, if I'm on an income-based repayment, as we're showing on screen, $250 per month, that's the payment I'm going to use for qualifying. Even if I have $100,000 in student loan debt, if that payment is zero, and that's what my income-based repayment was, that's the payment we're going to use for qualifying purposes. I'm going to jump back to credit because we had a question come in the chat, which is, what's the maximum optimal number of credit cards one could have without negatively impacting on their credit score, assuming one pays on time, not exceeding the credit? There really isn't a maximum credit number of credit cards that I could recommend. I think that what it's going to come down to is where you have those balances at. I think the optimal level is going to be having the credit balances below 10% of the credit limit. I think the timing of how you are applying and getting those credit cards is probably more important, because if I go out and set up 3 or 4 credit accounts in a span of 6 months, then I'm going to have a pretty negative impact to my credit score. But if I have several different credit cards that I've had over the last 10 years and I'm managing them just fine, then it's really not going to hurt you. But I think it's just the timing at which you open those credit cards. Let me answer one more question, and then we'll kind of wrap up on student loans, go to the next topic. So question is, where can I get a deeper credit report? I noticed that I would have much higher credit score when I used online credit reports, and my bank consistently tells me I have a 780 plus credit score. But when I went to get my housing lease application, it showed me a different score. So that kind of goes to my point earlier, which is you're monitoring scoring. So what you're getting provided by American Express or your bank account, that's going to be a credit card score. But when you're applying for something in the housing space, they're probably using a mortgage score. So whether that's leasing or buying. And so that's why you're having a little bit of a different scoring showing up. Okay. All right. And so just to kind of wrap on student loans. So, student loans are coming due in October. We all know that. Now it's, question if you're going to have a, income-based repayment amount for your qualifying, or if we have to apply the 0.5% or 1% for the conventional loan product. All right. Let's talk about loan programs. And these are 5 core loan programs that we generally talk about in our home buyers workshop. And, it's our goal to kind of find the right product that makes the most sense for you on that journey towards home ownership. So I want to spend some time giving you a little bit of a deeper dive into each one of these products, because you've probably heard about them, but it's really important, obviously, as a first-time buyer, to better understand how you can get the best benefit out of these products. So the first one is a conventional loan, minimum down payment of 3%. When you hear in the news, Fannie Mae did this or Freddie Mac did that, we're talking about conventional loans. They originate 60 to 70% of all mortgages across the country. Okay, so that's obviously a hot product or hot topic for most buyers. It's not just for first-time buyers; it can be second and third-time buyers. The Fannie Mae and Freddie Mac guidelines are all set by FHFA, and there's limits based upon where you're going to purchase using a conventional loan. So there's a thing called a conforming loan limit, which in Virginia is 726,200. Now, if you're joining us from New York or California or other maybe high cost of living markets, the loan limits actually go up as high as $1,089,300. So what is different though is when you go beyond a conforming limit amount, the minimum down payment that we have on screen, which is 3%, that's going to jump to 5%. And so if I'm going to buy in LA County, for example, and I want to buy $1.2 million house, I'm going to have to put 5% down instead of the minimum of 3%. Now, conventional loans have a minimum credit score of 620. So something to kind of keep in mind. And we're going to do a side-by-side comparison of conventional loans versus FHA loans relative to mortgage insurance in just a second. But conventional loans are going to be really looking for a pretty clean history of credit in the most recent 12 to 24 months. Now, FHA loans are first of all, let me tell you what FHA stands for. It stands for the Federal Housing Administration. So FHA loans are not going to be just for first-time buyers. They can be for second and third-time buyers. So this is a product that adds more flexibility to the buying power for a homeowner. It's a minimum down payment of 3.5%. Up to the conforming limit of 726,200, just like we saw on conventional products. Now, FHA, as I mentioned, has a little more flexibility in guidelines, minimum credit score of 580. The same holds true that there is higher loan amounts available if I'm looking to buy in a high cost of living market. Now, the next product is our VA loans for our veterans that have served. So the VA product can be used multiple times. There is eligibility based upon your service, and what is provided to the veteran is generally a certificate of eligibility, and that will determine eligibility to the loan product. VA is an awesome product because it allows a veteran to have 100% financing, so no down payment. And in some cases, there's what we call as a funding fee. There's always a funding fee, but in some cases, if a veteran's eligible, that funding fee is completely waived. Now, the VA recently has made enhancements to the guidelines that allow veterans to finance above $1 million and more, depending on your lending situation, with still a 0 down payment option. So really cool product for our veterans. And then USDA on the right-hand side of the screen is a product that allows buyers to purchase in more rural or lesser populated areas. Now, USDA, believe it or not, it stands for the United States Department of Agriculture. So that's true. Now, USDA has 2 qualifiers that are really important. It's about location with USDA. So depending on where I'm going to purchase, has to be a USDA eligible location. And there are maximum household income requirements depending on where I'm going to purchase with the USDA product. Okay. I had a couple questions that came in in the chat here really quick relative to VA. So I want to just make sure I answer those. And I think I just commented on this. So, which is, a veteran that has 10% disability or more, the funding fee is waived. So that is absolutely correct. And so I think we had a comment of that in the chat. And then another question was, is it a good idea to make a down payment for a VA home loan, even though you're not required to? And I think that's a great question because it really just depends. So as we meet with you to design your financing options and figuring out what the right monthly budget is for you, it may make sense for you to pay a down payment. You don't have to, but it may be something that you may want to consider because maybe you have a target number you're trying to get to. All right, let's wrap up our product discussion talking about jumbo loans. And it's not for a lot of our first-time buyers, but I think for some of us that are looking to purchase at maybe higher price levels, maybe above the conforming limit for Virginia or maybe any other market, a jumbo loan is usually going to have a higher down payment minimum, which is usually 10 to 15% of my sales price. Not only do I have to have a little higher down payment, but I also have to save up for what we call as closing costs. You heard me mention about that earlier tonight. And then what's different with jumbo loans is they also have reserve requirements. And reserves are assets that I have saved in addition to my down payment and my closing costs that I can have left behind to be able to show more stability or compensating factors for my financing. Usually the reserves are 12 months equivalent of my monthly mortgage payment. So if my mortgage payment is $6,000 and I have a 12-month reserve requirement, that means I need $72,000 worth of additional assets. Okay, so that's the jumbo loans. I want to talk now about PMI, and PMI is private mortgage insurance. And you may have heard or seen things online about PMI because, you know, there still is the misconception out there that if I do a conventional loan, I have to put 20% down, which really isn't the case. Now, I know many of you have probably even started doing some searches on Zillow or Redfin to figure out what some different options might look like for you in your particular market. And there's some great payment calculators that are there as well. But a lot of those payment calculators are a little bit inaccurate because they don't factor in the correct level of PMI. So tonight I want to spend some time sharing with you what PMI looks like on a conventional loan, but also what it looks like on an FHA loan. So let's first talk about the different payment options on a conventional loan. So there's monthly MI, there's split MI, and what split MI is where we take and we pay some of it up front. We also pay some of it on a monthly basis. So you have kind of two components there, right? Then you have single premium MI, which is where I basically buy out the MI in its entirety. Doesn't happen a lot, especially in today's market. And then lender paid MI, which is where I take a higher mortgage interest rate in order to completely buy out my mortgage insurance. The most popular option is generally monthly MI. And the reason for that is because MI generally has a cancellation option. So once I have 2 years in the home and 22% equity, I could potentially apply to have my mortgage insurance canceled. Now, PMI, as I mentioned earlier, has three main factors. It's based upon credit score, how much I put down for my down payment, how much I finance. And so, you know, what's one of the big misconceptions is that a lot of people, when they do their searches, especially starting off with Zillow or Redfin, see this mortgage insurance amount. And they're like, wow, it's $300 for mortgage insurance. But when we take these factors into mortgage insurance, it's not actually as expensive as you might think. Let's look at this example here at the bottom of our screen. So if we had a $450,000 loan amount, we're putting 3% down. We have a 740 credit score. My mortgage insurance, believe it or not, is not as bad as you might think. It's only $183 a month. So significantly lower than the $300 or $400 quotes that you'll see sometimes online. Now, again, higher I can get my credit score, the more my down payment is, the better my cost is going to be from a mortgage insurance perspective for the conventional loan. Now, FHA loans, it's a little bit different because FHA has two components to mortgage insurance. There's monthly mortgage insurance and there's upfront mortgage insurance. The monthly is a factor of 0.55% of my loan amount. My upfront mortgage insurance is 1.75% of my loan amount. Now, mortgage insurance on FHA does not have a cancellation option like the conventional loan does. So in order to get out of mortgage insurance with FHA, I'm going to have to probably refinance at some point and try to move maybe into more of a conventional product. And I think that's a great strategy for clients that need FHA for their financing because FHA, as I mentioned earlier, a much more lenient product than we compare it to the conventional product. Now, let's look at the calculation of FHA mortgage insurance. So we take that same loan amount of $450. The PMI with the 0.55% factor is $206 per month. Plus, we have to add upfront mortgage insurance that gets financed into your loan balance. So that's another $7,800 of one-time fee that gets put into your loan amount finance. So now I'm financing $457,875. So obviously a lot more expensive in the FHA space than it is on a conventional loan. Again, you may step back for a second and say, wow, why would I go FHA? Well, not everybody's situation is the same when it comes to designing home buying options. So FHA is going to give us that leniency from a credit score perspective. Maybe I've had some past challenges with the late credit card payment. And so that's where FHA will give us a little bit more flexibility there in the qualifying. And so it's really our goal to find the right product that meets our clients' needs after we have a conversation during a consultation. I know we've had a few questions come in about VA loans. VA works very similar to FHA in terms of the flexibility. So if I've had some past challenges, VA is going to allow us to get a little more flexibility in the guidelines, where if the conventional product, I'm really going that direction and I had a late payment on a credit card 2 months ago, it may disqualify me from a conventional loan. But everybody's situation's a little bit different. Before we move on, I got one more question that came in on the chat, going back to kind of the thought around, should I pay points on a loan to buy down my interest rate versus putting money down towards a larger down payment? And so that question is one that comes up often right now, is investing in down payment versus investing in lower interest rate. And my hunch is that it probably makes more sense to invest towards down payment. The rationale behind that is, as I mentioned earlier, buying discount points, it's probably going to take about 3 to 4 years to break even. Hopefully we have opportunities in the next 2 to 3 years to refinance out of a loan so we can lower that interest rate to more normalized levels. And so you probably won't get a good return on investment by buying points, versus if you decide to finance less and put a larger down payment, now you've expanded your equity position, hopefully. So when it comes to refinancing, you're in a better spot and you have more options to choose from. Okay, hopefully that answered your question there for you. Let's talk about documentation when it comes to home buying. What are the things I'm going to need if I do want to start this path towards home ownership? We're going to look at things as it relates to just the income side of documentation. So if I'm a W-2 wage earner, I'm generally going to need the last 2 years of W-2s. I'm going to need my 30 days of recent pay stubs. And then during the lending process, we do verifications of employment. Usually there's a written verification and then a final verbal verification done at the end. Now, if I'm self-employed, in fact, I was talking to one of our self-employed clients earlier today, it can be a little bit more documentation intensive. Would definitely need the last 2 years of taxes, usually a profit and loss statement and a balance sheet. We do have to show that you've been active with that business for at least 2 years. Now, that brings up a good point here that I want to talk a little bit about, because there's a lot of misconceptions around employment history and how that can impact you from a qualifying perspective. A lot of lenders will say, I need to have 2 years on the job before I can be eligible, and which it really isn't the case. The Fannie Mae and FHA guidelines require that we have either 2 years on my job, 2 years work history, and that could be through on my job or my multiple employers, and or education. So let's say I graduated from Virginia just in the spring, or let's say the fall of last year. I just started my job in the spring. If I can show I have my 4 years of education under my belt, plus my new job that I just started, that would qualify me for my 2-year work history. Another question that comes up a lot is that, Jason, I'm thinking about switching jobs. I've been at this job for 6 months, but I have a new opportunity for another job. Can I get qualified using the new income of the next job, even though I'm not going to be on that job for a certain amount of time? And the answer is yes. So as long as we have an executed offer letter showing your start date and pay and everything, we can use that for qualifying purposes. So something to kind of keep in mind. Now, where it gets a little tricky is if you have multiple employers. So let's say I'm working in the healthcare industry and I work for one clinic for 30 hours a week, another clinic for 20 hours a week, and I'm working a total of 50 hours. In that case, I do have to show that I've been able to hold down both positions for a 2-year span of time. So that's where that rule, 2-year rule, will come into play. For self-employed individuals, as I mentioned, it's 2-year requirement. Now, if I have a W-2 job that I work 40 hours a week, right? But I also drive for Uber on the weekends to make a little extra money. In order to count the Uber income, I have to show that I've been doing both the 40-hour work week job and the Uber driving consistently for the last 2 years. All right, last point I want to make on income, and we'll kind of move into assets in just a second, is around having additional income in my household. So if I'm applying by myself and my spouse has income, right? So my partner has income, but my partner's not going to be part of the loan application, then my partner's income cannot be factored into qualifying. For most products too, if I'm renting out a room with my current situation, we'll see that where somebody's renting a room for $500 a month, but my client's on lease. I can't use that rental income for the purchase of the next property unless there's, a future room and board situation and I'm not using like a first-time buyer product. Okay, so hopefully that was helpful on income documentation. Let's now talk about, or actually let's wrap up with qualifying income. I actually want to give you guys a quick calculation around debt to income ratio. And it's a really simple calculation, but I think it's helpful to understand as future buyers. And this is a determiner of qualifying, not necessarily of affordability. Affordability is a really deeper conversation we're going to have during the consultation. But debt to income ratio, simply put, is your gross monthly income versus your monthly expenses. We're looking at your household expense, like your mortgage payment, of course, credit card debt, personal loans, car loans, student loans, all that stuff is looking at those obligations versus your monthly income. Generally, we don't want the debt to income ratio to be more than 43 to 45% of your total gross monthly income. But when we think about the calculation, it's based upon gross monthly income, right? But for you and I, we don't budget off of our pre-tax number. We budget off of what we take home every month, right? So I think it's really important to understand that even though it's a qualifying measurement, it's not necessarily affordability. In some cases, we can go up to as high as 50% debt to income ratio, which is super high. We kind of avoid doing that unless we know there's some additional income that maybe we can't document. Here's the calculation of debt to income ratio here. So principal and interest, taxes and insurance. There's PMI, so private mortgage insurance, HOA. So if we're going to buy maybe in a condo development, maybe a townhouse. So those are kind of like communities that have special amenities, right? So that'll come with an HOA fee. Those can vary anywhere between $200 to $400 a month. But those will want to be factored into those type of properties that we're looking at qualifying under. And then, like I mentioned, other debts like personal loans, credit cards, any type of auto loan payments. In this scenario, we have a housing expense of $2,500. We have $500 in other debts. We compare that to our $8,500 worth of gross monthly income. Then that debt to income ratio is at 35.29%. So the question I get often is, well, where do we think we should have the debt to income ratio at? And for most of our first-time buyers that attend our classes and work with us on their home buying plans, we generally see a good comfort level around 33 to 36% debt to income ratio. Okay. All right. The last stop on this journey in homeownership and putting together our plan is going to be around assets. As you heard in our introduction of tonight's classes, there's two challenges usually for first-time buyers. Could be credit, because maybe we're a little overextended or maybe we're just not in the best possible position. But more than likely for most of our first-time buyers, it's around assets. I just haven't got a chance to save enough up for my down payment. Now, you've heard about the minimum down payments on loans, so they're a lot probably lower than maybe what you initially thought before you attended tonight's class. So that's encouraging. We're going to talk about assistance programs in just a bit. But let's look at the documentation that we need when we save, we provide proof of our savings. So of course, checking in savings accounts are allowed. We have to see the last 60 days worth of statements. Cash deposits that we have into those accounts cannot be used, because every dollar that's used in a home purchase has to be paper trailed. Retirement accounts can be potentially used. So 401ks, 403bs, even IRA accounts can be used, but you want to be careful. And I would really encourage you to talk to your financial advisor, maybe your tax advisor, just to make sure you're not creating a tax event by accessing some of those investment vehicles. Gift funds can also be used. So what are gift funds? Well, gift funds are going to be when a family member has said, hey, you know what? I really want to help make homeownership happen for you. So I'm going to contribute funds towards your home purchase. There's no limitation on gift funds. And the only thing that the donor would want to talk to is their tax advisor to make sure there's no tax implications. Gift funds, unlike our own funds that are up here at the top, do not need to be seasoned. So they don't need a 60-day seasoning requirement. Generally, we just need to see a gift letter from the donor as well as proof of the asset account that they're going to pull that money from. And that obviously happens quite a bit, especially for our first-time buyers. Now, for those of you that are just trying to save enough funds to be able to get towards home ownership, and maybe it's your 2 or 3 year goal and you just don't think it's something you can accomplish in the next 10 or 12 months. I think there's good news out there, because there's several different first-time buyer programs that are available all across the country. So whether you're in Virginia, Illinois, California, Texas, there's HFAs called housing finance agencies that can help get you on that path towards homeownership that much earlier. And so in tonight's class, I want to spend some time looking at the Virginia housing programs, just so you got a sense of the other resources that are available to you out there in the market. So under Virginia housing, there's a couple different products. There's the Virginia Housing Conventional Loan. And what it does is it allows you a little bit more flexible down payment options. You can participate in that minimum 3% down conventional loan, but then also get support to help cover that 3% investment. So there's the DPA grant program. DPA stands for Down Payment Assistance Grant, allows you to borrow 2 to 2.5% of the purchase price, but it's a grant. So grants don't have to be repaid, which is a great option. Now, not everybody's eligible for that grant, but that's a particular tool that you can use. Generally, with grants, you're going to have to make less than 80% of the median income in the market that you're going to buy in. And then there's also the Virginia Housing Plus Second Mortgage Program. Now that is a second mortgage. So we have our first mortgage that we're lending for the percentage of the purchase price. The second mortgage is 3 to 5% that can help support you with your need for down payment. It can be used towards the down payment or closing costs. So maybe I already have my down payment covered and I just need help with closing costs. The Virginia Housing Plus Second Mortgage can be a resource to help support you there. Now, most first-time buyer programs have minimum income limits. And specific to Virginia housing and most programs, it's going to be by county that you're going to buy in. Here's the income limits for 2023. These get updated every year. So whether I'm going to buy in Washington or Richmond, those income limits will look a little bit different. And again, there's products very similar to this all across the country. So if you're attending tonight's class from a different market, we can provide you all the materials and resources you need on first-time homebuyer options. All right, now I talked to you a little earlier about getting on that path towards homeownership and taking a quick closer look at the 6 steps of home buying. So that's what we're going to do now, kind of really get a good idea of what's the workflow look like to purchase my home. And so after tonight's class, you may hopefully want to get a chance to get connected with us on video or phone and design a home buying plan. Well, the output of that consultation is to get pre-approved. And what does a pre-approval mean? Well, pre-approval allows you to better understand what your financing options are, what it's going to take for you to reach home ownership, but it's also a certificate that you can give to a seller that says that you're eligible for your financing. Now, the pre-approval is usually good for 60 days, but that can be recertified at any time. So that's one of the great benefits of the pre-approval. And there's some flexibility in the pre-approval. So we generally try to figure out a baseline for you with your pre-approval, and then we can make adjustments to the pre-approval based upon how your home search is going. I'm going to take a quick step back because we had a question in the chat. I want to answer it before we get too far into the 6 steps, which is when we look at the income limits for Virginia housing, are they based upon household income or are they based on application income? So most programs are going to be based upon applicant income. So that's, but we have to kind of look at the specific products. Some programs will be based upon overall household income. So if I'm an applicant, I make $100,000 a year, but my partner makes $50,000. Even if my partner's not going on the application, that $50,000 could be factored into the overall qualifying for that first-time buyer program. For the person who asked that question, we can kind of talk offline and figure out which program you're going to look at and where you're buying, because it'll change based upon the guidelines for that particular market. Okay. All right. So we learned about the pre-approval. We know that's going to be something it's going to show us the eligibility for our financing. Now, step 2 is the fun part. That's the house hunting. That's where you get a chance to partner with a realtor, kind of take a look at places that kind of match our criteria. So usually your search will start online, whether it's Zillow or Redfin or maybe a portal that your realtor has set up for you. Once you're kind of excited about a few properties, you might even want to hop in the car on a weekend and go tour some properties. Believe it or not, in this 3-day weekend, we had a lot of buyers out doing that. And the nice weather, in most parts of the country lend to most people kind of checking out some different open houses. But we would encourage you to connect with a realtor. A realtor is going to be an expert in their market. So they're going to be able to show you those different options that make most sense based upon your home ownership goals. Now, let's say I go out and start looking at homes. I see a house I really like, and I want to submit an offer on the house. Well, the realtor will help design that offer for you. They'll submit that offer to the seller. And if the seller accepts that offer, then we move to step 3. That's called entering escrow. That means the seller said, yeah, we want to accept your offer. And then what happens from there is the lending process kind of relaunches again. Now you're going to have to make an earnest money deposit, usually in most states, which is going to be 1 to 2% of your purchase price. That's a financial investment into the purchase. And it usually needs to be deposited into escrow or with an attorney within 2 to 3 days of the accepted offer. Now, within at least 24 hours or sooner from when we get notified of the accepted offer, we're going to give you a call, schedule you for a follow-up consultation over video so we can talk about the design of your home buying options. Make sure you understand what your interest rate options look like, your program, of course, out-of-pocket expense, all that stuff. And then within 72 hours of the accepted offer, you're going to be getting disclosures sent to you. They're going to highlight things like your interest rate, your payment, your out-of-pocket expense, and they should generally match up to what we reviewed in your follow-up consultation. Here's what an earnest money deposit looks like. So it's 1 to 2% again of your purchase price gets deposited into escrow. It's a good faith deposit that tells the seller that obviously you have a stake in this transaction and the success of that transaction. Most states usually have what we call as contingencies to the contract, which allows you as a buyer to do your homework on the property, including getting the house inspected, which your realtor would help orchestrate, getting your loan approved, which of course I would handle as your loan representative, and then getting your house appraised, which we'll order as well, because we want to make sure your home's worth what you're paying for, right? Those are all important things to ensure, especially as a first-time buyer, that you're making a great, sound investment for you. All right, so that happens in the contingency phase. Now, the contingency, depending on where you're buying, is anywhere between 7 days to 21 days, depending on where you're at in the market or where you're going to purchase in the market. Step 4 is going to be processing and the underwriting of your loan. That's a lot of the administrative tasks of the loan. In this market, we're going to probably have your interest rate locked in by that time, and we're going to submit everything to our underwriting team. Your loan gets approved at step 5. Does that mean it means an underwriter has said, yep, you're good to go? And they'll generally give us some conditions that we'll work on as part of the approval. Well, this also brings us to the end of our contingency period. So we're probably 3/4 of the way through the buying process. At step 5, you as a buyer will have to make a decision if you want to move to the final stages after you've done all your homework on the property during the contingency period. If everything checks out, you're good to go, then you'll sign off on the contingency. That tells the seller that you're happy with everything and you're ready to move to the final stages. We're also going to deliver to you a final closing disclosure. So you as a buyer have the protection of knowing that there's no changes in your financing from the time at which a closing disclosure is issued, and then you have a 3-day cooling off period before you get to step 6. And step 6 is a big day because that's the day we get a chance to sign our final loan documents. And that process usually takes about an hour to an hour and a half. You'll meet with a public notary, or maybe attorney or an escrow officer, depending on the state you're going to buy in. After that is completed, then you're going to wire in the funds for your mortgage closing. That's your final out-of-pocket expense. That money gets reconciled with the escrow officer and attorney, I should say. We'll also wire in the funds of your mortgage. The money gets balanced and reconciled. And once everything is kind of checked off, then documents get recorded with the local county recorder's office. Usually it's a grant deed to transfer ownership to you, and a deed of trust, which is your agreement to repay the loan. And the exciting part really comes then, because then we get the confirmation that your loan has recorded with the county, and now you're the official owners of the home. And I got a chance to call and congratulate several of our buyers this morning because they've successfully navigated the waters of homeownership, and now they're getting the keys to their house today. So those are like probably the best calls I get a chance to make during my day, because it's a time of celebration. The process obviously doesn't come with some a little bit of anxiety and stress, because it's a big deal. It's going to be the biggest purchase you're going to make probably in your upcoming financial futures. But we're here to help support you through a high touch experience that leverages technology and the human touch of just making sure you know exactly what's happening during the process. And after attending tonight's class, you may want to hop on that path towards homeownership. And if you're ready to move forward, we'd love to be able to get connected with you for a consultation. That's an opportunity for us to meet up over video, design some financing options. Like I said, whether you're going to buy this month or next year, we want to just be a partner for you on that path towards homeownership. Now, maybe you have some questions after tonight's workshop, and you just want to maybe have a one-on-one to talk through some of your questions or your scenarios. We'd love to be able to meet up with you for an introductory call. Here's what the consultation looks like. And it's a free service we provide to you. So we don't have an expectation other than giving you the tools and resources that you need for home ownership. And it's looking at your credit. By the way, we only do a soft credit check. We're going to look at your budgeting. We're going to talk about interest rate options, program options, assistance scenarios, everything that you need to be able to be successful on this path towards home ownership. Okay. All right. I had a question that came in, and we're going to almost get to the end of tonight's class. Let me just make sure. Okay, this is a one-on-one question that came in the chat, so I'll let that go, and Ken will help me with that one. I mentioned to you leveraging technology. That's a really important part of the experience for a client. And our mobile app does a great job of that. That allows you to start the application process all through mobile, but you can also do payment calculations. So if you're out on a Saturday at 2 o'clock in the afternoon and you want to see what that house is going to be, the payment's going to be on that, you can do that right from mobile. You can also follow the milestones of the processing of your loan. So really great tool. It's available, of course, for Android and iPhone as well, too. We're super proud of our partnership with our UVA alumni. And this is, I think, our second class now that we've done in 2023. And the classes just get bigger and better. And I'm really excited that you guys got a chance to attend tonight's class. We also have other partnerships across the country, and it keeps growing month by month. Schools that are looking for more resources for their alumni, and just really helping support their local communities. And so if you have friends, family, maybe coworkers that are affiliated with any of these universities, they're more than welcome to come to these free classes. Of course, we'll be hosting more UVA classes. We have 2 more classes left for this year. You can find out all information on your dedicated website. Also, you can visit us at mortgageeducate.com for more information. Here's all my contact information. If you want to get a hold of me, you can text, call, whatever's good for you. You can email me, and we would encourage you to follow us on our socials. We try to put a lot of good content out, especially for first-time buyers, topics that are relevant for them on this path towards home ownership. We also have a lot of great testimonials that we like to share. You'll see a lot of that pop up in Google, many of which most of our clients come from classes like this. And so they tell their stories of how they started here right in this classroom to be able to actually reach the goals of actually getting the keys to their home. So it's really cool to see all the feedback that we get from our buyers that reach that goal of home ownership. So, with that said, I know we're just at the top of the hour, maybe a few minutes over. I want to go ahead and now open it up for any more questions that we got. We've got a lot of good interaction in the chat tonight, but I want to make sure that I answer any questions that you may have from the audience. So we're going to go ahead and keep the chat open right now and answer any remaining questions that you have. I do appreciate everyone hanging in there. Glad we have a full class here for tonight, and we've had hopefully a lot of good interaction here. So feel free to drop any questions in the chat, and we'll get those answered right now. So question was getting my contact information. So my contact information is right on screen. So you can get a hold of myself or Ken. Can all be reached there. That's a direct cell phone number. You can also just message me. That make it easier. And Ken just put in the chat our website here too. And you'll be able to see on that website, you also see your dedicated landing page, which highlights our UVA benefits, as well as kind of just the application process if you guys want to get started on that. Hey. All right. Okay. Question just popped in, which is important to understand, is what is refinancing? And I think we kind of just assume everyone understands what refinancing, but refinancing is different for different types of loans, right? There's student loan refinancing where you're trying to basically lower your interest rate, auto refinancing, which you're trying to lower your interest rate on an auto loan. It's really no different on mortgage financing. So what you're trying to do is get a lower interest rate because the market is supporting a lower interest rate. And as I mentioned earlier in the slides, in 2021, when we had the lowest levels we've seen historically at 2.5%, many consumers were refinancing to help lower those interest rates. And that's something eventually when you become a homeowner, you can partake in. If rates go from 7% to 5%, it may make sense to refinance. interest rates will cycle just like the housing market cycles. And, hopefully at some point as owners, you'll be able to take advantage of that. But ultimately what we're trying to do is lower our monthly payment through refinancing. Sometimes there's other reasons why we're doing it. Maybe we're trying to take equity out of our house. Sometimes that's an option that some consumers want to look at. But generally speaking, it's to lower the monthly payment. Okay. I think we're okay. Well, if we don't have any, got another question. Okay. So the question came in is, are there limitations to the number of refinances you can do to one property? So there is not a limitation. You can do as many refinances as you want. I think the thing you want to be cautious of is, am I getting a good enough return on investment in refinancing that home? Because refinancing is not a no cost option, right? There's going to be costs involved. We call those closing costs. Just like when we buy a house, there's the same costs involved with refinancing. So, refinancing can cost $3,000 plus. So you want to make sure that you're having enough savings in accomplishing your goals to get a good return on investment of that cost that you're spending. So, all right. Great questions tonight, everyone. So I think we did it. I think we're good on our questions, and I appreciate everyone hanging out to the very end. I know it's getting late, but thank you so much for attending tonight's workshop. Again, as a reminder, the recorded version will be available to you as well as all of our presentation material. Any of our classes, like tonight's class, can all be found on our YouTube channel. So it's just J Mada Mortgage. Feel free to subscribe to that. We try to do some live classes too on other hot topics that come up throughout the year. So thank you again for coming to tonight's class. We hopefully get a chance to connect with you soon for a consultation. Have a good night.